Today we're going to have a look at the ARMS position testing workspace in ARMS. And we're going to specifically have a look at the position testing tab of this workspace. And the point of this workspace is to drill down into why a certain specific position would contribute to the overall VAR in some non-adequate way. And we try to pinpoint why is this specific position doing what it's doing. And we also have the possibility to do some simulation using a certain position and change it. And we're going to have a deeper look into that. So this is quite a extensive workspace with a lot of features. So I'm going to try to go over some of the main features of this workspace and see if we can have some use of it. So first of all, we need to choose a date and a portfolio. We're loading the trading book and we're loading all the positions. And then we're going to move the parameters to the side so we get some more space. And as usual, we have the primary choice of evaluation date and risk date for the risk to where the risk calibration stops. And we choose the currency and a method of VAR and the horizon and confidence interval as usual. And here comes some of the new features not available in other workspaces. We can compare to another date using the same positions. And you can either have a clean comparison, which means that we're comparing the exact same positions for both different settings, or we can have a dirty comparison, which means that we're going to move 1 day back and fetch the positions from a previous date to compare with. And obviously this one of the main reasons why a certain position might have a different VAR would be that it's actually changed in size. So if someone sold off half of the notional of a position, then obviously it's going to change in the value at risk. So you can see if any parameters or any other settings to a position has changed in the dirty mode. So we're going to start out with the dirty enabled, and we have some splits that we can show as well, and we're going to be happy with these settings, the other ones. And then we ask for a calculation. And now there's a lot of things that needs to be done, so it takes a little bit. And here at the bottom, you get all the positions. As in previous workspaces, you get a position by position analysis. But here you can also see you get the market value, but you also get the market value from the previous date. And this will be the compare previous value date and compare previous end risk date. Which means that you're ending the VAR analysis 1 day earlier than the original. So if we would set these to the same parameters dates, we would get the same, and so we can compare to have a stressed VAR, for instance, by sending this date back in time and then compare on the same line. So here you get the positions with the current and previous setting. But these positions also act as position choosers. So this is the novelty here. And we set in the active parameters, the only active setting here, this is just showing the settings that you're running with. And here you can have the portfolio mode, true or false. So if it's false, we're just analyzing one position at a time, the one we're choosing. If you have the portfolio mode set to true, then we're analyzing changes to one position to the results of the whole portfolio. So we're going to start with the portfolio mode false. And then we're going to choose a position to analyze. So we're going to double click on one of the positions, which means that it loads. And then as we have the dirty setting, we get the current position. And we also get the old position from the previous date. And this position hasn't changed, so it's identical, obviously. we're analyzing two identical positions. But we can start this analysis. First, before we start, we can also see that we get the results in the center with it has a bigger font, so you can see it clearly. So you have the pink is the current one, and the green is the simulated one, and you see the diff. So now we can start playing around with this position and see how this would affect. So if we, for instance, would switch to maturity and set something else. So let's say it matures in 18, 12, 16 instead. So it becomes shorter, and then immediately we see that we have valuation change for this. And we also saw that in this we see the risk factors that are active for this particular position when we're running in a single position mode. So obviously it got shorter as well. So here we can then simultaneously do a change to this risk factor. So here down here we have a base curve and we have a credit spread curve for this mortgage bond. So we could add a bit to this. So we add some value to this credit spread, and then we can see that we're getting also differences in the valuation coming from changing both the risk factors and the position itself. So just click on the position again, and we'll reload, and we get back to original, and the diff is 0. And to see a certain risk factor, you can double click on the risk factor, and then you get to see the history for the last 100 days or so. So this is the 3-year credit spread over the swap, and we can see that the credit spread has contracted as opposed to the swap rate, which has gone up. So these are the two interest rate risk effects affecting this fixed coupon bond. So we can play around with the position values and also the risk factors and see the result. So now we can also get the portfolio mode. So we will switch to the portfolio mode, and now we can see that the present value is now the portfolio present value. And the simulated is the same, but when we start changing. So if we would now change this position, let's say we take another notional value of this, then we see the change of this to the complete portfolio. So we can see how much the value at risk changed when we stepped up the size of this position. And now we also see all the risk factors for all the positions in the portfolio that are active. So now we also see the volatility surface for the equity option, and we also see some general mortgage spreads, some government spreads. And again, we can play with these and see the history, and also change the values of these to some other number and see how this affects now the whole portfolio. So now when we do changes to this position, it affects the whole portfolio composition. And we also now see that we get these splits activated. Obviously, it makes more sense to have splits if we have a portfolio. So now we can also see changes to risk in the risk factor splits, and also in the position splits. So, and then if we would want to analyze in a portfolio mode the equity option, for instance, then we can load the equity option, and we can say that we have a put instead. We put false. And then obviously the whole game changes in this portfolio. We get another present value, another value at risk, and so on and so forth. And then we can see if we have any material changes in the volatility surface. So we can choose a volatility node, and we can see that there are no major changes to this. And then if we want to test to see if we have just a stressed var, we can go back and we start over the analysis and see, okay, we make a clean comparison. We have the same value date, but we're going to choose a period of risk that dates 20 business days back. So we're now going to do a total different analysis and see how, if we would run a historic simulation, everything else being equal, ending 20 days back or just 1 day back, we can then see that the present values are identical since they're being valued at the same date, but the var numbers differ. So we can then see that since then the var has gone down dramatically, and it's specifically coming from this mortgage bond that is has a lot less risk, even though the market value is the same. So we can then try to pinpoint why this would be, and we can look at some mortgage spreads and see why this would be something generating much less risk. So probably we're getting a historical sample that disappears from history as we go forward, which means that we get a lower var going forward. So because now we have done 250 days and 270 days, stopping 20 days ago. So that's the comparison. Well, this is what I wanted to show. It's quite a versatile workspace with a lot of information. This DG here is for delta gamma. Just curiosity, you get then the deltas and the gammas of the whole portfolio. If you switch on to the delta gamma. So you get the whole story. Here you get the first and second order sensitivities of all the portfolios. If we do this for just in portfolio mode, you get the delta and gammas for one position only. It can also be convenient to look at. So this is the option, having these deltas and gammas. Well, that's it for now. Please contact us if you want to have more information about how to use ARMS for your positions.